a very tricky and difficult time for many people. For us, we are doing a webinar, but there are, my hearts and prayers go to the people who are in the time of distress. This webinar, as we have called by the name, this really depicts that there is some serious problem in how the energy systems in the world are being managed. There are countries with great energy resources, but we still are in a situation where we are having all the wars, all the conflicts to resolve, and we are still not able to find. So that's why we termed it to call a virus. Now, the purpose of the webinar is not to really go into the calls and forecasts. I think the humble truth is, as much as we try to make calls, sometimes we get it right. But now I think the situation is in a different trajectory. So our goal here is to really talk about the framework and how to understand why did we land here, and also what is the future possibly, and that can give some views about what's happening right now. So XAnalysts, just a very few seconds. It's a startup. It's 170 a day. It's in the energy market, sort of a business. And we are providing a lot of content, thought leader side, and we have other team members supporting us. I also want to thank some of the partners which XAnalysts works with: Vortexa, Refinery Calc, really in Houston, General Index on prices. And then, yes, I'm really delighted to have Rachel, founder and who started the Ziemba Insights. So let's get cracking. And these are some of the questions we got from a lot of people. Line products market, what happens there? Probably somebody's asking how safe is Hormuz to, or can it bypass? How the entire OPEC will do, what are the short-term price effects, long-term price effects, and ultimately how it affects China, I think, and how it affects Europe. So these are really the kind of the key questions, and probably we will be covering all of them. And then at the end, if there are questions, then we'll cover those. So this has been my thought process, that we were in sticky 60s, oil prices going to the 70s. Slides back, I was so far of the view that 80s could be elusive, but now we breached the target today. We touched 84, and now the oil prices at this moment are probably around 82s. I'm still not in the camp of the 90s or the 100s. And that's why I put out something on 10 reasons why the oil will not touch 100. But let's see, I could be wrong. But so far, I guess the 100 doesn't seem to be in sight. This is what the EIA forecasted on the Brent spot prices. Certainly, I think this was done before all of this was happening. This was an year of glut, and that's why you see the oil prices going below $60 barrel, and also on the Henry Hub side from the lower levels. And probably, Paul, you might talk about what's happening on the gas side. There's another news which might be tempering a little bit of this, that the US is worried about rising oil prices because of this strike. So there is some thinking going on around this. So let's see there are not a lot of tools. US does not have the SPRs filled to the brim so that they can do a lot of things. But yes, the SPRs are there, probably plus 400 million barrels, but they should be somewhere around 600, 700. So not a lot to do, but let's see what happens there. The biggest thing to watch in the market is, instead of the flat price, I think this is a curve that shows how Dubai curve has moved since the middle of February to March. You can see the latest dotted line. It has really gone into backwardation in the front, though we had seen some contangos appearing now and then, and the entire curve was flat, but now it's in a different trajectory. We also want to talk about that the conventional thinking is OPEC, non-OPEC, US, China, and we want to just put some provocation that is this thinking obsolete, and we have seen US talking about a Western Hemisphere dominance of the energy side, connecting Canada, Latin America, and the US. So that's something we will talk about. And ultimately, the main thesis which we are working with, that whether it was Venezuela, whether it is Iran, whether it was Russia, there is a lot that is building up towards, and it's not an isolated one event. This is an event towards how to get China and US deal happen. China has leverage with Venezuela, with Iran, with Russia. So that's why we believe that a lot of scenarios are possible. And we wrote about the scenarios. We'll talk about one scenario, not the scenario. And I think there are many permutation and combinations, but our main thesis is that this is all geared so that US and China can probably find some meeting ground. And US has been working hard to remove all advantages for China on the cheap energy side, on the discount side, on Venezuela, Iran, and Russia. So a very interesting way could be that we'll be, in some years' time, we'll be talking about a WOPEC and a non-WOPEC versus the terms we use. Is just a bit of a stretch of imagination at this point of time for me. But I think good way to think about what could happen next if US really wants to go this path of energy dominance. Let's take some view on what's really happening in the Hormuz. This time around, not last time, in last year on the 12-day war, we had seen the global count of the vessels had started falling much earlier than the crisis happened. So there was some preparation. There was some already movement happening because of the US military being there. Don't know the exact reason, but we had seen this movement already happening. Yes, there was a news around which probably gave some calm that is not closed, but it is almost financially closed. So I think the meaning of Iran closure has probably shifted now. Marco Rubio came just now that the main aim is to really degrade the naval capability so that they don't interrupt the shipping anymore. I don't know, Rachel, maybe you are waking up and still catching up on your coffee. Any thoughts on this topic? Is it closed, not closed? How to really look at it?
So I think it's functionally closed. I don't want to parse hairs here, but with insurance cover not available and tankers concerned, I don't think that commercial actors are buying the point from the Trump administration that it is still open. Now, I think later today in U.S. time, we may see some announcements. I'm hearing that it may be on the insurance side, providing reinsurance cover and others. That may help a little bit, but at the end of the day, I think there needs to be either sort of sufficient military response or some sort of a US-led or group of countries that maybe get involved in either not only providing insurance, but maybe even escorting vessels. And it's not clear to me we quite have the military dominance yet. I would defer, I know that Paul also has some thoughts on this. So I think functionally, we are seeing it closed. We are seeing fuel shut in. There's probably more to say on that on the natural gas side that Paul will come up with. But this is something I think if the US government had planned for this, which they claim they had, I don't think they did the best job signaling. And the US messaging of, on the one hand, all Americans should leave the region. And by the way, Hormuz is open and commerce can continue. There's a little bit of cognitive dissonance there in my mind, which suggests to me there's going to continue to be significant frictions. And this is relevant not only for oil and gas, but also for fertilizer and other related products that can't fully take alternate channels. So we'll see what the U.S. pulls out of their hat. And I would also be watching what China does with its strategic stockpiles. You just mentioned a moment ago that Gulf producers and Iran got as much oil out as they could in the last few weeks. That reduces the impact of the physical shock and transit shock that we're experiencing right now. But it's a question of how long this lasts.
That's the question, which probably nobody knows. Well, let's keep building a thought process and probably we might get some answers. This is where we clearly say who is exposed. I don't need to go more. Saudi Arabia, UAE, there's a lot of talk around. They have options, but I think really Iraq and Kuwait are where probably they don't have any options. And that's what probably is really the worry around. We also were tracking a lot of the sites which have been hit. I think so far, my understanding is that all of these sites, there is more news than real thing. One example is the Ras Tanura refinery, which was hit by a drone. And of course, the refinery shut down from a precautionary measure, but it wasn't a strike that really kind of destroyed a lot of the refinery part. It was an offsite strike. So I think that's also we need to be watching, that there might be big news, but it might not be actually the news of the damage. Now, let's come back to a little bit setting the context that this Iran attack is not an isolated event. The way I see is that if we look at the trajectory of oil supply and demand, we have been growing steadily from 1995 just to the COVID side. Of course, the slope continued to change. So imagine if we had continued in the same path, we would be at a much higher demand levels right now. Probably, I would say 5 million barrels, 4 million barrels per day. This is a hypothetical number. So there has been a big demand correction in the world, but the supply correction is where the challenge is. As you can see, this data by EIA tries to show the red line consistently above the blue line if nobody really cuts production. So this supply correction started with OPEC cuts, didn't work much. Then we have the tariffs and the sanctions. Always there were mutations like a virus, the shadow fleets always found a workaround. And that is why I believe that we are in a volatile supply correction sort of a time. Also, there is a big divergence when we look at the OECD world and the non-OECD world. We can clearly see the red line non-OECD supply versus the non-OECD demand. There's much more supply, whereas on the OECD side, the demand is much higher. Of course, sort of going down, but the supply is less. So there is quite some mismatches, and the world is not finding the right mechanism, the market mechanism or the OPEC mechanism. So I think the mechanisms are kind of broken. That's why we are probably landing into this situation. Now let's focus a little bit on the what we call VIR, Venezuela, Iran, Russia. There is a big, strong base. They were once many years ago at 18 million barrels of production, came down to 12. Then again, the high oil prices pre-shale allowed them to go to 16. And of course, after COVID, this has been trying. But over the period, what also we have seen, especially about, let's say, Russia and Iran, they have also invested quite a lot in the downstream side and refining side, and not just crude, but product exports have been. So overall, this is a 10 MBD surplus system, and I think US is trying to find a way to deal with it. Maybe something on the gas side. This is again a big system, Paul. And any thoughts you want to offer here?
No, nothing particularly here. I think everyone's familiar with Russia and its gas trajectory the last few years. Perhaps folks are less familiar with Iran. I would just note that Iran is a little bit similar to Venezuela in that the reserve numbers are staggering, but they're probably even outclassed by the numbers needed on the investment side to actually get those resources out of the ground. So in a different world, Iran could be a major gas exporter, but they're largely confined to remaining under the ground for now. And it will be interesting to see the trajectory that this course takes, because as much as there are discussions about there being a gas glut globally already now, if you want to bring prices further down and you want to control a country like Iran directly, if that's feasible, there are a lot of reserves that one could add into the market that are probably not priced in by the market at the moment because of its complexity to make that happen.
Thanks, Paul. Now, if we compare VIR versus the US exports on oil, from where they were exporting 12 in 2017 and US was just now, US and these two systems have come sort of a neck to neck. That's why this competition is probably becoming what we have started to call the virus of the oil markets, given so much of headache, instability, volatility, and it's becoming a harder to solve problem. Now, this is where maybe, Rachel, you want to give a little bit more of where China fits in and a little bit about the global economy state.
Thanks, Mukesh. I did want to start with this sort of slide just to sort of highlight that the bulk of exports from Venezuela, Iran, and Russia are really going to China. I mean, here you're showing it as Asia. And in this sort of period of time, we really have a story where Russia's trade in particular really goes to, now is going to China. For a period of time, it was going to India as well. In part, that was a US and G7 effort to redirect flows to keep Russian flows from sort of leaving the market. But we really see a dynamic that as sanctions tightened, as workarounds for sanctions increased, that China really became the primary buyer from these countries, and that the whole system that was created, illicit financing, old vessels, extending the life of rickety vessels that probably should be scrapped, for safety reasons and maritime security, have continued to have that lease on life. And what's China gotten for it? They've gotten cheap energy. This is something that the largest Chinese refineries can't take advantage of because they want to maintain global market access, but it has supported these teapot refineries and smaller independents. And that is not the main driver of Chinese competitiveness, but it's definitely one of them. And I was mentioning earlier these availability of cheap fuel, both sanctioned and unsanctioned, was something that China took the opportunity to build its stockpiles, both onshore, building new caverns and facilities, but also implicit offshore oil that put it in a better position, going forward. I'm not saying there's enough in the stockpile to replace Middle Eastern flows on an ongoing basis, but it does, I think, put China in a relatively stronger position than it would have been a few years ago. China's growth now is less oil linked. It's very electricity linked. And there is a trend going on around some other emerging economies where the fuel that supports the electricity goes on. Now let's move on to the next slide, Mukesh, if we can. Did you want to say something about energy dominance, or should I?
Oh, go ahead. I think this is really a key,
sure,
where US is becoming a 10 MBD neck to neck.
That's definitely correct, and of course the U.S. The U.S. is not only a major player on the oil side, but a major player on the gas side. Where if anything, which I'm sure Paul will talk about, but which if anything has more significant rise. I know that I think last month we celebrated the 10th anniversary of the U.S. as an LNG as a natural gas exporter. This is a sort of key part of the story. What we see here also when we layer on the oil and gas, but also as Europe has relied less on Russia in the last few years, they've become more and more reliant on flows from the U.S. Now, there also are electrification shifts and power source shifts in Europe as well. But I think the bigger picture is also to what extent is the U.S. able to and willing to use its energy dominance theme to actually support the energy sector. For much of the first year of the Trump administration, we saw, I often like to say that the U.S. policy was drill, baby, drill everywhere but the United States, because the U.S. government was relying on regulatory changes, but the price environment was not incentivizing new drilling for oil products. The current dynamics with oil prices rising are probably providing new scope for producers to hedge, and may mean the drop off in U.S. production in the next year or so maybe less extensive. The bigger question is to what extent the U.S. greater involvement in the Western Hemisphere will perpetuate that growth. We've seen Brazil, we've seen Canada increase their production in the last few years. The U.S. In some ways, both Canadian infrastructure and pressure from the U.S. have actually encouraged a bit of a diversification of Canadian flows. That comes to play in our VIR talk because, of course, Canadian crude faces competitive problems from Venezuelan crude in the U.S. Gulf Coast, not for the U.S. overall. Why don't we move on to the next slide and say one more thing? So, I talked earlier about the scale of the energy exports. What's notable also in creating this system whereby these countries relied on a parallel market has been actually how much these economies, Venezuela, Russia, and Iran, have either didn't have a lot of savings and financial assets to pull on, or drew them down in the case of Russia. Now, in the Russian case, that has to do with the situation of total war that has materialized. But what you see is even a few years ago, the foreign assets per capita, the savings per capita that Russia had, paled in comparison to those of some of the Gulf states, especially Qatar, UAE, and Kuwait, where the savings per national were quite extensive. And then we've noted here on the slide that Russian liquid assets have fallen to about $50 billion. At the same time, domestic debts have risen. They're nowhere near what they are in Venezuela, which has a significant debt burden that will constrain its development going forward. But these are definitely countries where oil and gas via China was a lifeline, but not one where there was a high standard of living. So overall, we're looking at a circumstance where energy in these illicit systems created a lifeline for these countries, created competitiveness and benefits for some of the buyers, but one in which there were some real externalities in the global financial markets and the like. If I think looking ahead, what is the U.S. goal in this context? There are many, and that actually I think makes it harder to fully unpack where the off-ramps or where the deals might be struck. Trump himself is a deal maker, right? He thinks he is. He likes to push for as many targets as possible. But I do see a common thread here. One of the U.S. goals is reducing the discounts going to China to reduce a move away from transactions in the U.S. dollar and U.S. financial system. Maritime security might be a far secondary goal. There is, of course, a real divergence in place between the U.S. and European Union about which parts of the shadow fleet and which parts of VIR to target, with the Europeans much more focused on Russia. I think if we're talking right now, there are a number of aspects of the conflict and pressure on Iran that actually can increase the leverage or dynamics with Russia, particularly as we might see some more revenues starting to flow in. We might see some tensions in part exacerbating the tensions in the European Union over sanctions enforcement, I do still think we still might be a ways from final resolution. But it is clear that the U.S. interests include trying to reduce these sort of discounts and the virus that has benefited other parts of the global economy. The challenge is timing, I think. China's biggest leverage on the United States is critical minerals, and that's something that can't be stood up overnight, and maybe we'll have more to say about. But what is clear here is that having redirected Venezuelan flows back onto global markets mediated by the United States, that there are major changes in the markets ahead. But the very conflict we're seeing and freezing of not just Iranian supplies but also others in the region creates a number of risks. As Mukesh said, the question is, how long does that last? How quickly can facilities be stood back up? That's something that will frame the different scenarios. And finally, I alluded to this earlier, but this just gives us a size of how large the shadow fleet has become compared to the overall tanker fleet. The shadow fleet has continued to grow in recent years, starting as a very small fleet. And that's partly as new tankers are sanctioned, going into more and more risky activities, that you actually have other clean vessels coming into that market, being sold into that. And what we also see here on the chart on the right is how actually Russian direct ownership of those vessels is quite sizable, and I would say has been increasing in the last year compared to the first couple of years. That has to do with an element that Russian trade, like that of Iran, has gone deeper into illicit channels, which makes it harder to stop, increases the need to use military sort of tools in that way. And I've written recently on weaponized economy about the interplay of using kinetic activity to enforce economic sanctions, which is a trend we've been seeing. Now we've seen that in two countries, and that is a risk. Also, we're seeing other countries get involved in tanker seizures, even India getting involved in some token seizures of tankers. So all of this, plus the military risks, are, I think, why tanker owners are getting more cautious. And then I think you have to layer that in with the fact that tanker ownership has also become more concentrated. And so we're far from a cartel there, but there is a sort of an asymmetry of financing. Now, I think I'm going to stop here and let Mukesh and Paul sort of talk, sort of add some of their thoughts.
Thank you, Rachel. Let's keep going. I think, Rachel, you painted a clear picture of China financial situations. And I think we want to build this theme, continue forward, that there are mechanisms to solve the supply-demand mismatch. The market didn't work. Then became the sanctions and tariffs that only emboldened, and China became a big reason of why the VIR continues to survive. Then the geopolitics tried to solve it, but it's not able to solve it, because there's one thing where things are not working is the chemistry. So what you see on these two charts, one is the Venezuela-Iran crude exports. They are really the medium sour and heavy sour kind of barrels, whereas the US crude exports are all the light sweet barrels. Now, the global refinery system was not designed for too much of the light sweet kind of quantity going out into the market. They were more designed like the US Gulf Coast was designed, and some of the older refineries, and most of the refineries in the world are aging. We haven't built new refineries in the OECD part of the world. So this quality mismatch, that US can't keep all of this crude at home. US needs a different kind of a crude, and also this crude might not be useful for other players. Now, China may be a big place where this crude can go from a petrochemical point of view, but then US and China are kind of in tussle. Similarly, if you look at the chemistry of the product side, these countries, they didn't build sophisticated refining systems, so they have been still exporting quite a lot of high sulfur fuel oil, some of the VGOs, some of the naphthas and gas oils, and really a small amount of the high quality products, whereas the US exports are mostly on the light end side. And these light ends were a perfect feed for China for the petrochemical side. So in some ways, yes, all crudes are not made equal. I think that's easy to understand, but there's a lot of chemistry on the product side, which is not allowing for these resolutions to happen very quickly. And with that, I come to this point that since even in December, the thesis was that whether it is Venezuela, it's about China. If Venezuela was not selling anything to China, probably nothing would have happened. If Iran was not selling to China, probably again Iran would have been spared. So there's a lot of connections. And while we are in the war, I believe US has already started talking of a meeting, and there is a meeting soon going to happen. So this clearly reinforces my point that this is not about Venezuela, Iran, or China. This is ultimately US trying to put a leverage and pressure on China. And US had found quite a big room for its propane, ethane, even the light sweet barrels going into China up to 1.6, 1.5 million barrels per day. But then it came down into half of sorts. So US is really looking at home. That's why they can do drill, baby, drill. They can't keep all the light ends at home, so they have to find a market. And China is the biggest petrochemical side of the market. So this is where things are. And as Rachel was pointing, US needs from China all the critical minerals. So the thesis is that what kind of a scenario we are going to go into the future and what is not priced in. I'll try to simplify here. The VIR advantage of China has been eroded significantly. So that gives a signal that probably when Trump goes to China, he has much stronger cards, though I have started to sometimes doubt this kind of a thesis, given the way the Middle East, this would have been more successful had US and Israel achieved quite a successful and swift sort of control over Iran. But nevertheless, assuming that soon US would have dominance in the Middle East and over Iran, maybe a Venezuela-style dominance, then US can offer some of the Venezuelan, Iranian barrels to India and can really force India to go to zero, and probably India can go to zero. That puts pressure on China. So with having good hold on Venezuela, Iran, and even Hormuz, probably under the US dominance, it can put huge pressure on China and provide a big squeeze. That's what looks like the US has been trying to achieve. Now, that's where it comes, whether China has the cards, like Rachel mentioned, some of the critical mineral cards, but we still believe that these two economies cannot stay fight. US can fight Venezuela, fight Iran, fight Russia and other places, but China probably not, because they both need each other. The politics may not work, but the chemistry certainly requires that. So our view is that the bias is that probably US and China will find some strategic alignment such that US gets what it wants from China, but also not letting China win like in the past. And the hope is that with such a pressure on China, US might be able to resolve the Russia-Ukraine war. And that's where the trajectory of the oil markets go. Now, this is one scenario. Maybe I'll just pause here, Rachel. Anything you want to talk, and then we'll jump into the gas side. What other scenarios come into your mind?
Yeah, I think that the only thing I would add here is that, just as we said with Iran, that there are sort of multiple goals that the U.S. has at play, including some question about, is the goal regime change or just regime pivot, a more pliable government as they've seen in Venezuela, a question if they're interested. I think there are multiple interests at play vis-a-vis China. And you're right, the U.S. is looking for more markets, both for some of those products. But there's another factor we haven't talked about, which is the U.S. focus on reshoring, the use of tariffs to generate revenues, tariffs, of course, charged on Americans, not on foreign companies, but that those can create conflicts with some of the other goals. And that as we get closer to the meeting between Xi and Trump at the end of the month, those goals can come into to conflict. The U.S. government has been much more focused on getting market access for agriculture than it has for energy, at least vis-a-vis China. And so those tensions sort of come into play. I do think that the security risks that the U.S. saw from both Venezuela and from Iran, and of course, from Russia, were a major driver. And the goal wasn't just, getting China out of the way, but the goal was reducing those security risks, which China was enabling. I may be splitting hairs a little bit here, so let's stop doing that. Yeah. But I do think there's that element where there's some side benefits of side benefits in these different goals. At the end of the day, I think there is one of the big questions for this year is not only whether these conflicts get resolved, whether these transport channels get reopened, but also how the global economy deals with a massive surplus or a trade surplus from China, right? I think the trade and tariff war is something we're seeing spread to other markets, and there's a lot more frictions being developed, not only the shadow fleet associated with VIR, but a lot more trade, sort of trade redirection, which might be good for shipping and tankers in other parts of the world, but might not be great for the sort of end users. So I do think that this has some concerns for final demand of some of the products we're looking at. So that's another sort of scenario, I guess, I'd throw into the mix, where maybe some of the conflicts drag on, where there might be more sort of regionalization, and the trade, the sectoral trade blocks come into play. Will the U.S. care more about reducing China's energy, or that China buys U.S. chips? These are all sort of, I think, catalysts and signposts that I would be watching in the next couple of weeks, as the two countries, both countries, have an interest in keeping the sea lanes open. The U.S. because they want cheap energy and they want market share, and China, of course, because they are a major seller of non-oil products.
Maybe, Rachel, let's talk a little bit. Sorry to interrupt, because I want to give Paul the time for the gas side. So I think our main thesis is what may not be priced in is India's purchase of Russia going to zero. What may not be priced in the market is the selective disruption of the Hormuz under US, so that they don't give more barrels to China. What may not be priced in, how US and will resolve the chemical side of the market. Now, with that, probably it's time to talk, Paul, about the gas side of how do you see, is it a primary, secondary infection, as you call it?
Yeah, great. Thanks, Mukesh. Look, I think before getting into the specifics of what we're seeing in and around Hormuz, I think it'd be great to take a step back and really just talk about the nature of gas markets and how they're similar, perhaps, and also more importantly how they're different to oil markets and why that matters. And I think the first point to make is that unlike in oil markets, where, as we've heard this evening, the primary virus can be the manipulation of great powers, such as what the US is trying to achieve, firstly via Venezuela and now via Iran. The gas market virus is something different. It's not one of great power manipulation. In fact, the virus is more what I call a secondary infection. And this disease's mode of action comes from trying, but failing to copy that of the primary illness, being the oil market and its structure. And so what do I mean by that? If you look at the LNG market structure, there is a weaker exporter to importer ratio. If you look at the Vortexa data just quickly, as I did before the webinar, you'll see there's about 75 oil exporters and at least 90 major oil importers. Whereas with LNG markets, there's only about sort of 25 or 26 exporters and double the amount of imports. So there's much greater reliance on a smaller pool of supplies. And as a more immature market, there's a relative deficit of the oil market's deep physical and financial liquidity. The other point of contrast is that the LNG market has emerged relatively quickly, relatively recently, and it's come from a story of there being, in many parts of the world, a long history and an economic and population level comfort with a gas pipeline first supply mechanism. And this has, in many cases, been substituted quite abruptly by a complex, global, divisive, and seaborne LNG market. And so what are the consequences of this? What are the symptoms of this sickness? Well, what's happened is that you have a senior supplier pipeline relationship risk, which is sometimes it's large, sometimes it's small, but it's quite definable and better to have something that you can at least measure versus a risk that now in the LNG world is multi-factor and multi-actor, and it's based on risk probabilism of something happening in any part of the world that could affect the whole system, but without having those buffers that the oil market has developed. So what was marketed as flexibility in the global LNG market has in fact, in reality, become instability. And all of the importing nations, being diverse economies, markets, and populations, they're all now bound to each other by these events that have now happened twice on a large scale in the last 4 years. What affects one affects all. Next slide, please. So because of this, in oil markets, the sort of one-to-one US to China, US to Venezuela, this sort of, maybe we think about it as a traditional sort of linear great power relationships. They have less of an abrupt effect on third-party actors. There's a greater system flexibility, and both Mukesh and Rachel have talked through a lot of the details of that. Whereas, in gas, and really what we're talking about is LNG markets. Any such manipulations or attempts at them, for the reasons I've said above, and some more that I'll mention, they inherently carry larger and more significant collateral damage risks. There's less system flexibility and there's greater brittleness. Gas has very broad use cases, for heating and cooling, for power generation, and industry across many economies. Whereas I guess we think about oil being confined to transport and industry, some power generation, and the broader real economy with a sort of a lagged effect. I guess the way I think about this is given that we're in military times, I can use some military phrases, the sort of higher collateral damage or the higher body count of any attempted gas market manipulations or ructions makes makes it much more politically treacherous for any actors like the US that are trying to bring about specific geopolitical ends using energy markets as a vector, and this sort of effect threatens to some degree the effectiveness of the US virus theory of geopolitical manipulation we've been talking about, because it's not just a series of oil consequences that it has to manage economically and relationship wise. The thesis I'm stepping out is that the gas market consequences are much more complex and much less manageable. And you see this where in 2022, when Russia thought it was really impacting only the EU itself, it had all sorts of indirect and secondary consequences where the price of gas fed into unaffordable price of fertilizers, and you had significant agricultural yield drops in notional countries allied to Russia, such as Egypt, that it had to manage, as well as plenty of other significant consequences. We're seeing this now with Iran and Qatar, where there's already second order and third order consequences. And in the future, as the US role in the LNG market is slated to become even larger volumetrically and on a percentage share, you could even see a much stronger division of internal opinion as that demand for US gas globally inevitably causes a rise of US domestic gas prices, with populations within the US losing out from that. So if we do think about Russia 2022 as a sort of 20th century style prototypical villain trying to generate a sort of a simple linear bad consequence, already less than 1 week into this conflict in 2022, we're seeing a very non-linear complex system unfolding, where US Israel has triggered Iran, which has triggered consequences for Qatar and the UAE, which is going to trigger who knows what, already much less than a week, and we're having to work through all these consequences. Next slide, please. So finally, bringing it back to the current crisis that we're dealing with, and for anyone who's interested in our views on Qatar and Hormuz on the gas side specifically, we put out a note last night for members that we've made free for all interested readers because of its importance. We figure that this is not the sort of seminar to go into percentage splits of where Qatari LNG exports abound and things like that. There's plenty of excellent material out there on that, including from our partners Vortexa, so I recommend that to you. But instead, I want to kind of maybe draw people's minds to a few thoughts as to how this is going to play out over the coming months, rather than the the next few days or week, if in fact the Hormuz crisis, part of the crisis, endures. And those who have read my note last night will understand that I have skepticism about that. Notwithstanding all of that, taking the last sort of 5 or 6 minutes of explanation into application concretely, what are we left with? Well, we're left with the conclusion that supply fragility, both actual and potential, matters, and this is well understood by the market, whether it's Russian pipeline gas that has been discussed for decades, or Qatari LNG that has been discussed continuously, more or less, since that industry was stood up around 30 years ago. But what is less understood by the market, and what is more complex and in fact more important, is the demand optionality away from gas as a fuel to be consumed, and LNG spot markets. That was a significant consequence of 2022, is a significant consequence in 2026, and there are different actors that I'll run through that have made more or less progress in developing that optionality away from those two facets of gas. And I think this is much less understood by the market, at least at a granular level. So look, demand side flexibility is very complex, and partly
sorry, just conscious to maybe leave some minutes for some few questions as well.
I'll wrap up in these last 2 minutes, if that's okay. So look, demand side flexibility is complex, and it is partly a matter of choice as to whether an energy system wants to run its coal-fired power plants or its gas-fired power plants. The flexibility extends across the power sector, across the industrial manufacturing sector, but also because many of these are developing countries, there's an energy efficiency or non-consumption choice. But when it comes to human comfort, such as heating European houses, that is somewhere where demand flexibility does not exist. And we're also looking at demand flexibility across other sources of gas and switching either to coal, to renewables, or in the medium term, renewables build out. So who has this demand side flexibility? We know already from analysis of Qatar's LNG exports and its contractual structures that this is going to be an Asian story. And we do know that there is significant demand side flexibility on the oil liquid sides, particularly in Asian refineries where feedstock can switch between gas and LPG. Chinese trucks can switch between LNG and other feedstock. We know that on the coal side, Asian power generation and also in the US can switch between gas and coal. And there's a little bit that remains in Europe, particularly in Germany. If we're looking at other sources of gas, China has developed its own domestic production and Russian pipeline imports significantly since 2022, whereas Europe really has little improved exposure to price volatility. It was Russian pipeline dependence before, now it's US spot LNG exposure, and Japan is in the same boat. We also know China and developing Asia as well as Australia have built out a lot of renewables since 2022, and that explains why the price hikes we've seen this week, while dramatic, have not been a repeat of 2022. Just to wrap this up, you'll see from the bottom of the slide, China has much more flexibility and wealth and decarbonisation focus to endure the crisis without suffering living standards. South Asia, as in 2022, is much less in those circumstances. There may be power shortages because of elevated prices, but that would also be a way of avoiding further embedding of higher gas prices in global economic chains. Europe has much less of that flexibility. So as in 2022, Europe will set the price in this crisis, but that's if it even endures. I think the US has a lot of military incentive to protect its ally Qatar, who now has its major revenue source under threat, purely for helping its ally US initiate this action, partly using its territory. And I'll leave it there.
Okay, thank you, Paul. Now, with that, I think let's have some questions. But our main thesis has been that even if it is 4 weeks, who knows? But this war will likely end with some US dominance, as we have seen. If that doesn't happen, then yes, different outcomes. And that brings US-China deal has a much higher chances versus previously. And what I've been saying, peace is not bearish, but peace is bullish because it is going through a very disruptive process. Let's see, anybody has got questions or some got questions got answered?
Has a question. I might throw one out to generate. For Mukesh, what is your thought? I mean, what is your thought on China's replaceability of the barrels they've been getting from Iran from a weight and blend perspective? What do you think are the better, the better options if the teapots and others are forced off of using that?
I think the short answer, Richard, is that Russia was making the medium sour and the light barrels. India was taking the medium sour Urals. China was getting all the lights. China was getting the Venezuelan heavy, Iranian heavies, blending. Now, with this situation, when they don't get Venezuelan barrels, when they don't get the Iranian barrels, possibly going forward now, this will be much on the US discretion, then China's ability to absorb all of the Russian lights is going to be challenging. Plus, China does not have the advantage of the waterways and how Russian crude can go to China. So I guess that this really disturbs the Chinese refining system. And Chinese refining system was moving towards a different level where they were buying the petrochemical feedstocks from the US and running the refineries in a different way. If the US-China, there's no deal like we have seen, then they have to reorient the refining system to again make the petrochemical feedstock. So I guess that's why I see US and China, the chemistry is so intricate that the only way is that they will have to do a deal. It's just that the process has been a bit messy and disrupted. Maybe I think we are by the top of the hour, so we'll make this also available online and we'll be available for more questions. Today, our goal was not to answer and give forecasts, but to give a framework to think about and hope we have succeeded. I would like to thank Rachel and thank Paul for connecting a lot of dots, a lot of complex dots, not an easy story to tell, but we made our best effort. So thank you, everyone.
Thank you. And look
Thank you,
forward to
everyone.
your future questions.
Thank you.
Thank you very much. It was very good.
Thank you. Bye-bye.
Thank you.
Thank you.